The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 8th of November, and this week I'm not able to welcome Jeremy McEwen because he's away for a couple of weeks. But I'm delighted to say that in his place, I've got my colleague Alistair Stewart, the building and construction sector analyst. So it's great to have you here, Alistair. Welcome to the show.
Thank you.
Alistair's going to be giving us a bit of commentary on last week's budget. So it'll be great to hear from him how he thinks that's impacting the UK sector and maybe a bit more broadly in terms of the house builders and across the building sector at large. But before we get to that, the big news this week obviously has been the US election. A number of surprises, but the main surprise is actually that we do have a result. It's come through very quickly. I think a lot of the markets were worried about the fact that we could have had days or even weeks of protracted battling and litigation or potentially even civil unrest if people weren't happy with the result they thought they were getting. So that has been a big piece of news that we actually have a result so quickly. More generally, it looks like the Republicans will be holding the Senate, and it does look like they're going to also get control of the House of Representatives. So in many ways, it's been a Trump clean sweep, which will give him clear mandate to put his policies into action, perhaps without much in the way of either official or unofficial pushback from the left. So a lot to grasp, a lot to take in. One thing that we don't yet have is any real signal from Donald Trump of how or even whether he will put into action the various policies that he's talked about or aired over the last several weeks and months. So there's a lot of unpredictability, which is generally concerning to markets. But overall, there are a couple of the biggest policies that we can look at. The drill, baby, drill mantra in terms of additional fracking or push for cheap oil and gas in the US, that should, all other things being equal, bring inflation down, flooding the market with cheap energy, both in North America and more broadly across the global economy. So that would be a deflationary impact of Trump. But on the other side, his talk about tariffs and significant levels of protectionism could lead to increased prices. Obviously, domestic prices in the States rising, that could lead to inflation being exported more generally. They're also talking about the impact of removing large numbers of illegal immigrants from the States and what that might do to wages, because majority probably are in jobs or in roles that would need to be filled by other legal migrants or US citizens, which, again, all other things being equal, would put prices up. So markets unsure exactly how that's going to play out, but equity markets responded very strongly on Wednesday morning. There was a big bounce on the back of the result. The US 10-year yield has edged up fractionally across the course of the week, but nothing too dramatic. And in the UK, the FTSE rebounded really quite nicely on Wednesday morning. But since then, it's given up all of those gains and slightly more. And I think the reason for that relates mainly to interest rates, because we've seen, hot on the heels of that quick US election result, we saw on Thursday quarter-point rate cuts from both the Bank of England and the Federal Reserve in the States. They both brought interest rates down by 25 basis points, largely as expected. But in both cases, the mood music has definitely become more subdued. There was commentary from both the central banks that the pace of future interest rate cuts was now more in doubt. Clearly, in both cases, responding to some of the uncertainty probably following the Trump election, and the unpredictability of his actions going forward could lead to inflation in the States. And here in the UK, I think there's probably going to be a bit of time before we see the impact of a number of the public sector pay rounds that have gone through various levels of quite significant pay increases being agreed with some large numbers of people across the public sector. And we've obviously got the inflationary impact of last week's budget. So both central banks sounding more cautious about the pace of future rate cuts, but we'll have to wait and see what the impact of that is really in terms of longer term interest rates and the way that economies react. But a little bit of uncertainty there on the rate side, but at least we have a result from the US. So that's the big macro backdrop. But the UK reaction to last week's budget, there's a lot to discuss. And it's a good way to switch and talk to Alistair Stewart, who's, as I said earlier, has joined us to talk about in particular, the building construction sector and the way that he feels Rachel Reeves's budget from last Wednesday might impact the sector more broadly. So, Alistair, great to have you here. What did you think of the budget, and what do you think it might mean for the stocks that you look at?
Yeah, hi Gareth, good to be back. In terms of the budget, there are certainly some potential winners in the construction and house building sector, but the real concern is in terms of taxation leading into costs. That could be quite a negative across the construction sector. And as you mentioned, rates came down on both sides of the pond, but the mood music has dampened down a little bit, especially for private house sales. That's always a bit of a concern. The real winners are affordable housing in particular. For the contractors, the construction groups, and the building material producers, there's quite a lot of new investment in clean energy, in the industrial side, and in infrastructure, and also in public building, particularly in schools and in hospitals and the wider health service. So going sector by sector, in terms of house building, the Chancellor doubled down on the manifesto promise to build 1.5 million new homes during the life of the Parliament. To be fair, nobody in the industry quite believes it. I'm on the more bullish end, expecting them to get close to it. I think really they're going to be a year out in it. But the fact that they're still doubling down on it, I think, is positive. As I say, it was more on the affordable housing side. So the grant for housing associations and local authorities has gone up by 500 million for next year. And it sounds like there's going to be more to come. An additional quite important element was they've tried to improve the financial conditions of the housing associations, who had been a bit battered in terms of borrowing costs, in terms of recladding, in terms of net zero commitments, and tackling damp in existing houses. That had put a huge burden on the main procurers of affordable housing. So the key thing there was they're discussing changing the rent growth for social housing to CPI plus 1% per year. That could be a big positive for them. A few years ago, they had eye-wateringly low borrowing costs because it was government backed. They had geared up to the eyeballs, but then the cost of borrowing went up and all these new costs came in. This will certainly help them.
So it frees up the spend. So the spend that's been allocated to maintenance, they can afford that more easily. So they can now start to invest in new properties as well. Sounds good.
And then for the private housing market and for private house builders, it was pretty much neutral, actually. I don't think the extra stamp duty for second homes really will make too much of a difference. In a way, the housing market had already slowed down in advance of a budget. After a fairly promising first half, I think it's a case of travelling and arriving. When they see it's not as bad as thought, that might pick up. And also, there were measures to improve delivery. The biggest constraint for house building had been the planning system, and she's now put in new funding for 300 extra planners. And that should help the building materials demand. In the last couple of days, the building material statistics have actually shown, for the first time in a long time, deliveries have picked up and stocks have fallen quite a lot. And that means there's better potential pricing power. So one of our companies is Forterra, the big one in the sector is Ibstock, so they could benefit from it. One final element is the repair and maintenance sector could get a big boost from the 3.4 billion warm homes program to increase insulation, put in solar panels in the roof and so on. So that can be good for companies like Mears or Canovo. Also boiler upgrades, that's a continuation. They pledged to continue the Conservatives' policy. So that could be quite promising. Moving on to infrastructure, people tend to think about roads and rail. There wasn't actually a huge amount in that, other than it's a relief to finally see the HS2 now actually going all the way to Euston rather than stopping at Old Oak Common, which just was a national embarrassment, really. But the big improvements are much more focused on renewable energy, the whole transition to carbon capture and storage. And there's 100 billion extra pledged over 5 years. So that should benefit the big contractors, such as Balfour Beatty, but the slightly smaller ones like Morgan Sindall, Kier, and Galliford Try do both infrastructure and affordable housing. So probably those three are going to benefit more than most people. There's also big spending plans in public building, specifically for hospitals and education. So some of that stuff will also impact the larger contractors, but it might trickle down to a lot of these smaller private companies. And then finally, in terms of industrial construction, that is probably going to help the future industries like battery plants and data centers, but also in terms of logistics. Trump coming in could lead to more what's called reshoring. And one of our companies, again, that should benefit, and we've written about this quite a lot in the past, was Severfield, the structural steel producer. So quite a few potential winners, but the two big drawbacks are, first of all, the national insurance surcharge for employers. That should take a lot of money out of the wider economy, which isn't really good for construction in general, because they tend to employ more people. And there's a bit of a triple whammy in terms of national insurance contributions. First of all, there's the rate going up from 13.5% to 15%, but also the threshold almost halving down to £5,000. And then, the triple whammy side of things is the national minimum wage has gone up. Now, not many people in construction actually earn that national minimum wage. They earn more than that, but those people just above that threshold will see everybody brought up towards them. So they'll start campaigning to maintain their differentials. So much more of a wage burden on which to apply that 1.5% more. That could be quite bad.
No, of course, yeah. As you say, employee costs across the sector are pretty high as a percentage of revenue. So it's a big number for them. And yeah, that triple whammy of the rate increase itself, the threshold coming down quite significantly. And then, yeah, your broader point about the rippling out effects of wage increases across the market, I think that's an important one to bear in mind. So yeah, a number of ways in which that's going to be painful for the sector, but equally a number of ways in which the budget was positive with, as you described, all the spending on infrastructure, building the schools and hospitals, and the doubling down on the house building targets. So brilliant. Thank you very much for your comments on that. Great to get the view on the impact for the sector, and we'll see in coming weeks and months how it all plays out. From me, in terms of our traditional look at the UK microcap space in the progressive client realm, we had two bits of news this week. We had DP Poland had a positive trading update. Their Q3 sounds like it's going nicely in terms of ongoing revenue growth and additional store openings. We also had a trading update from Secure Trust Bank, who are seeing a modest level of organic ongoing growth, but they are seeing the impact of the vehicle finance issues still bouncing around. So a bit of pressure there for Secure Trust Bank, but hopefully they can work their way through it. And then just to finish off by looking into next week, it's going to be a lot quieter. No huge news from the US political sphere and no UK budget. So that'll be a much easier week to work through in terms of macro news. The main piece of news is US CPI data, which is due out on Wednesday. So I'll be able to update on that next week. But Alistair, great to have you here. Thank you very much for your time and being here.
Thank you.
And we'll catch up with everyone this time next week. Talk to you then.
Brought to you by Progressive Equity.